This is a bonus video where I'm going to explain the SVB banking problem with a focus on IT services and why it actually matters. So I'm sure by now you've heard that on Thursday there was a bank run on Silicon Valley Bank. The reason why this happened is that the bank itself noted that it was running a little bit short of capital. It tried to raise some capital. When it did that, it made some notices to venture capitalists who do a lot of banking with the SVB bank, and there was a decision to short the bank stock. And these venture capitalists, who also tend to sit on many of the boards for a lot of the small IT startup firms, advised them that they should withdraw money from their accounts at SVB. This in turn created a run on the bank. Now, I'm sure that over time we'll figure out whether or not it would have happened naturally, but the long and the short of it is that the SVB banking system does not lend money the way that a regular consumer bank does, simply because the way that the banking is done there, many startup firms have their assets deposited in the SVB bank. Most of the small startups don't have any collateral to borrow against, plus they are cash flush from IPO and rounds of finance raise. So what happens is that the way that SVB was making money, because they have to make money on the deposits, and normally a normal consumer bank would take deposits in and then lend money out, and the arbitrage on the interest rate that they pay to the depositors and the interest rate they return on the loans that they make, that arbitrage would be the profit. Well, they're not making a lot of loans because that's not the type of bank that they are. So instead they invested in treasuries, but they needed to invest in long-term treasuries because the interest rates for the last 20 years have been so low. In doing that, when they needed to go ahead and get their money out, they needed to sell the treasuries, and because the interest rates have recently gone up, the yields on their treasuries went down, and so therefore they were taking out less than the full dollar that they were putting in. So that caused concern about whether or not they were fully capitalized. Long story short, there was a run on the bank. They were about $2 billion short, and over the weekend the FDIC and the Fed came in to shore them up. What this means is there is a push right now to make sure that all of the depositors are made whole. Now, why is this important? This does not just affect any of the startups that are located out in the California area. It affects companies around the country, and I dare say around the world. What happens is when a small startup goes out and raises funds, they very often go to venture capitalists on the West Coast, and there is a culture that says that when they go ahead and raise money and give up a portion of their company to the venture capital companies, those venture capital companies then make recommendations about where they should invest their money, where they should store their money, and SVB is a very popular place to put that money. Now, the issue is it's not just the very large multi-billion-dollar companies, but the small startup that maybe is located in Middle America that has 15 employees and is relying on those funds to be able to make their payroll. So that was an example of a tweet that went out the middle of Saturday talking about whether or not this company, a 15-person company in Ohio, was going to be able to make payroll, and what the repercussions on those 15 families, not to mention the owner's family, was going to be if they could not make payroll on the 15th. Likewise, you may have seen that Etsy notified its customers that they were going to have a delay in processing their payments. Now, what does that mean? If I go onto Etsy to order a custom-made pot holder, for example, and the person goes ahead and creates that custom-made pot holder and sends it to me, and I send them the money, that money that I'm sending actually goes to a clearinghouse through Etsy, and Etsy is using, you guessed it, SVB to go ahead and hold its money. So Etsy was concerned about whether or not it was going to pay all of the creatives who were creating products, selling them on the Etsy platform, because if that money was frozen, they may not be able to actually pay the creatives. So there was a knock-on effect where it's not going to just be the venture capitalists or the top 100 small startups, right, or large startups. It's little mom and pop shops, folks that have come up with an idea and built a piece of software, and maybe they got 10 million on a first raise, or they had $5 million in the bank on a raise that they had done recently to come up with some development funds. These are companies that are providing innovation to the world, but to the American economy. And there was a real concern about whether or not they were going to be able to get not just the maximum FDIC insurance, which is $250,000 per depositor, but if they had millions of dollars in the bank, whether they were going to be able to get that money back. It looks like the federal government and the FDIC, more importantly, is going to be backstopping that and making sure that they are made whole. But this also comes up with the question, why? And in large part, it has to do with the confidence of the market. So the same way that the bank run actually started, that can be a contagion. Specifically, because people perceived that the company, SVB, Silicon Valley Bank, may not have the money available to make all the depositors whole, people were withdrawing money quickly. And because SVB was making money by putting the money that the depositors had into long-term bonds, they needed to sell those bonds. And when they sold those bonds, they sold them at a discount. So they lost money on every bond sale that they made because they had to liquidate the bond before it matured. What that means is that the bank insolvency was a theory that became a reality because everybody said, let me get my money out of the bank before there's no money left. And that's how a bank run becomes a real reality rather than just a theory. There's a bit of a scare, there's a concern that there won't be money there, and so then people go to withdraw their money, and when they withdraw their money, there is in fact no money left because that's the whole point, and that's when the theory of a bank run becomes the practice of a bank run. It's generally believed that SVB is probably going to be able to recoup 95% of the assets without any other investment because they did have money available, it just was illiquid. So that's something that we can talk about a little bit later on, but the bigger concern was with Silvergate going under earlier in the week, and then you had SVB going under at the end of the week, and then over the weekend you had Signature Bank in New York going under. There's a concern that there might be a contagion in the market, and the full faith and credit of the United States could be at risk. And so the best way to make sure that that this would not be a contagion that spread across the entire banking industry was to backstop these banks, specifically SVB and Signature Bank in New York, with the hope that that would end the contagion. So we'll see if that actually worked, but that's why I posted on Sunday that the SVB problem may affect you even if you don't do any banking at SVB, or quite frankly are not a startup with millions of dollars in the bank, because if you happen to be an Etsy creator, this was the view that I had, was that you might not get paid in a timely fashion, and that can have a knock-on effect. So anyway, stay safe out there, and talk to you soon. Bye.